policy is not synchronized, no longer synchronized. Now, in the past, in the last couple of decades, the global economy moved in a similar pace. Now we're having a lot of disjointment, whether it is in terms of policies, whether it's in terms of economic growth paths, inflation, capital flows, and so on. Next slide, please. Next slide. Okay, so I said that next slide, please. So I said that the key message, I have 5 key messages from my presentation. One was the fact that global growth has been restored, but it's not moving together. The world is not moving together. Some places are growing, others are staying stagnant, others are still struggling to grow, but generally growth is restored. I said inflation is generally decelerating, and that's giving central banks the opportunity to start cautiously easing. But again, this is also disjointed. Monetary policy cycles are also fractured. Capital is flowing selectively. In Nigeria, I mentioned that we are seeing, following the reforms, we are seeing sustained disinflation, better FX stability, better trade balance dynamics, and improving market confidence. I want to also highlight here that yes, this is the case, but it's more or less, I wouldn't say we have reached a point where Nigeria is turning the corner. I would say that it's essentially, for Nigeria, we're just resetting. We're actually going back to where we were 10 years ago. So it's not that what we're experiencing now is really some kind of transformational thing that has never happened before. It's just basically taking us back to the steady growth and performance that we had maybe 10 years ago. Essentially just wiping away the last 10 years of where the Nigerian economy was really in a turbulent period. And you can check this out if you can confirm this if you compare most of the indicators today with the indicators 10 years ago. They're quite similar, slightly worse. So again, what we are witnessing today is a reset, not necessarily a point where we have reached some significant transformation. It's still more of a reset. And I think the point is the more we continue on this line, then we'll move from stability to transformation, but we're not in transformation yet. And that's the point I'm trying to make there. And then I said that the lesson here for my presentation would be that in 2026, there is no single policy path that is correct. There's no universal investment playbook anymore. And the kind of environment we are in, kind of global environment we are in, it is not the size of the company or the size of the country or how big the region is that will determine whether they win or lose. And we are seeing that even on the global stage. It is what is going to determine winners, whether it's sectoral countries, it's credibility, it's resilience, and it's also adaptability. Next slide, please. So I started off by talking about the, next slide, please, the global economy. I said that we are entering 2026 with what can be described as an uneven soft landing. And I said that this was being driven by 4 major forces. First one was divergent monetary policy. Second was geopolitical fragmentation. Third was the fact that technology-driven productivity gaps were widening. And I also mentioned climate pressures are becoming more persistent, as well as demographic shifts, which are all reshaping how labor markets are aligned and designed. They also shape how investment flows, how investment is flowing, as well as the direction of fiscal priorities. So global GDP, like I mentioned, has moderated to about 3% in 2024, down from 3.3% in 2024. And I expect it to stabilize slightly above 3% through 2026 and 2027. So while this is still slower than the pre-pandemic growth rates, it is still quite impressive because it's holding steady at 3%. I said impressive because if you compare this to the various recent shocks in the last 3 to 5 years, if you compare this to all the geopolitical disruptions, the trade tensions, particularly in the beginning of this year, It's been able to achieve a 3% global growth despite all this, to me, is quite impressive. And this is signaling a transition. So we are signaling a transition from post-pandemic rebound to a new mid-cycle equilibrium. But this era of soft landing I mentioned is uneven. In advanced economies, growth is decelerating, but in a controlled manner. The US is remaining resilient despite the um, disruptions, especially since the beginning of 2025, with growth. US growth is averaging about 1.8 to 2%, supported by household demand and labor market. In Europe, the economy is recovering. Growth is about 1%, led by its services sector. Despite the fact that manufacturing is weak, Japan and UK continue to face structural challenges due to their aging populations, due to low productivity, and they still have this subdued consumer confidence. But generally, policy paths in advanced economies are also diverging. The Fed is remaining cautious. Despite the aggression by the US president, remains cautious. The European Central Bank and the Bank of England are normalizing more gradually. And all of this is creating uneven financial conditions that matter for capital allocation. In emerging markets and developing economies, however, the momentum is much stronger. They are growing around 4%, led by India, that is growing about 6%. India's growth has been driven by digitalization and domestic investment. China is also stabilizing near 4.8% as its economy shifts from property-led growth towards consumption and technology. Also, China's more recent diversification into alternative export markets following the trade wars with the US has helped soften the impact of the US tariffs on its economy. In fact, it's performing better post-US tariffs than it actually did before. And it's actually the US that seems to be bearing most of the supply chain cost pressures created by that battle between the two countries. Across Africa and South Asia, structural growth premiums remain intact, supported by favorable demographics, urbanization, and reform momentum across many African countries. So the key takeaway here is that global growth is resilient, but fragmented. And success in 2026 appears to be dependent less on geography and more on policy credibility, stability, and reform commitment. And this means capital will follow predictability and not just opportunity, as it used to be as it used to be the case in the past. Next slide, please. Next slide. Okay. So inflation has also been one of the defining macro variables in the last 3 years. But the good news is that it appears that the world is finally turning the corner. Global inflation appears to have peaked at about 6% in 2023 and has persistently eased since then. It's projected to have fallen towards 4.2% from 6% in 2025 and expected to fall even further to 3.7% in 2026, and that's despite all the trade wars and continuous geopolitical disruptions. So it's moving to a range closer to the comfort zone of most central banks. Now, this disinflation has been driven mainly by supply chain normalization as well as more stable energy prices and generally cooling goods demand. However, in several advanced economies, core inflation, especially in services and wages, still remains sticky. And that's why, although central banks appear to be more confident, they are not completely relaxed because the risk of resurgence has clearly not disappeared. There's still a lot of things that could actually cause inflation to reverse. So central banks are confident, but cautiously confident. In emerging markets, the pace of disinflation is shaped more by food prices and FX volatility. And this is what will determine if that pace of disinflation that we are seeing in emerging markets continues or whether they reverse. Unfortunately, this is largely out of control of many of these countries, given the fact that the agriculture, which is tied to food supply, is rain-fed, given the nature of their exports, which are largely dependent on commodities, which are subject to vulnerable, volatile prices. And of course, that is linked to, makes them vulnerable to FX volatility. But in general, the global direction of inflation for now is clearly one of disinflation, which is resulting in measured easing globally. So the Fed, the European Central Bank, the Bank of England, and many others have all reached their rate peaks and shifted into a, should I call it a hold and assess stance. And rate cuts so far have been shallow but symbolic, marking the end of the emergency tightening era and setting the stage for continuing gradual easing into 2026. For emerging markets, especially in Africa and Latin America, they were well ahead of the curve. They started tightening early and are now benefiting from positive real yields and renewed inflows. Next slide. With respect to global capital flows, we are entering a new phase in global capital flows, one that can benefit emerging markets like Nigeria, but again, only selectively. For example, the US dollar, after peaking in 2024, is beginning to soften as rate differentials narrow, as FX pressure eases, and is also restoring confidence in emerging market assets. Also, capital flow indicators have turned positive and portfolio inflows are returning, while Eurobond markets are reopening, and investors are increasingly differentiating by policy quality. So in this cycle, the binding constraint is once again no longer global liquidity, but credibility. Those countries with transparent FX regimes, those countries with credible monetary policies and sustainable debt profiles are attracting more capital. And this is a trend I expect to persist into 2026. So capital is becoming less geography driven and more credibility driven. So for economies like Nigeria, capturing this opportunity depends on continuous policy clarity, depends on fiscal discipline, as well as reform continuity. Next slide. Given the structure of African economies, commodities remain the primary channel through which global shocks affect domestic balance sheets. So while commodity markets have stabilized after 3 turbulent years, volatility has not actually disappeared. It has just changed form. It has shifted from broad demand-driven cycles to one of more localized, geopolitically and climate-driven shocks. This means that those African economies dependent on a narrow set of commodities will continue to remain exposed to risks they can't control into 2026. I'll skip the details since you have the slides. I'll move to the next slide in the interest of time. Now, despite a generally improving global economy, the world has nevertheless become structurally riskier as we enter 2026, even if the head data suggests stability, as I've mentioned. Geopolitical conflicts continue to disrupt energy and shipping routes, while the US-China rivalry continues to fragment trade, continues to fragment technology and capital into parallel systems. Also, debt pressures remain acute, particularly in Africa, where many economies entered this period with post-COVID debt surges and limited fiscal space. At the same time, climate shocks have become macro critical, directly affecting food inflation, budgets, insurance costs, and even sovereign ratings. Now, none of these risks are new, but what is new is their intersection. Shocks are now more frequent and collectively destabilizing, making resilience the central policy and an investment imperative. Next slide. Okay, so before turning to Africa, I think it's also critical to recognize the accelerating pace of technological change that is reshaping global competitiveness. Advances such as generative AI and supply chain realignment are redefining productivity, they're redefining investment flows and opportunity sets worldwide. AI and automation are already transforming sectors from finance to manufacturing, and they are widening productivity gaps between those with strong digital foundations and those without. For Africa and Nigeria in particular, this presents both a challenge and opportunity. The challenge being the obvious lack of skills and capacity, but the opportunity being the ability to leapfrog development cycles through AI-driven efficiency in payment, logistics, public services, and education. At the same time, global supply chains are undergoing their biggest restructuring since the 1990s as firms are now shifting, like I mentioned earlier, from cost efficiency towards resilience and friendshoring. And while this tightens access to advanced technologies, also intensifies competition for Nigeria and Africa's critical minerals and creates space for the continent to position itself as a resilient, low-cost alternative investment destination. But that is if it aligns its policy, its infrastructure, and technology effectively. Next slide. Digital infrastructure is also now the backbone of modern competitiveness. Data centers, cloud platforms, cybersecurity, digital payments are increasingly determine where value is created. But for Africa, the continent remains underrepresented with just about 1% of global data center capacity, despite nearly a fifth of the world population. Again, however, this gap is also one of Africa's largest investment opportunities. Nigeria, for example, due to its youthful population, already vibrant fintech ecosystem, it positions it as a potential regional leader. But again, that is only if investment in broadband, cloud capacity, cybersecurity, digital skills, and so on can be accelerated appropriately. Next slide. Okay, so shifting to the Africa macroeconomic environment. Next slide. The key message here is that the continent's growth outlook is strengthening. Africa is projected to grow by about 4.1%. It's projected to have grown by about 4.1% in 2025, rising to about 4.4% in 2026. That's more than a full percentage point above global growth. And importantly, this expansion is becoming increasingly broad-based. Economies like Nigeria, Cote d'Ivoire, Ethiopia, Kenya, and so on are driving momentum, while resource-dependent countries previously drag on regional averages are stabilizing as commodity prices firm and as fiscal management improves. So Africa hasn't fully returned to its pre-pandemic 5% plus growth path, but the trend is decisively positive. Growth has strengthened each of the last 3 years, and despite the tariff-related disruptions early 2025, the region still outperformed 2024 and is expected to accelerate further in 2026. That said, despite performance, it still remains uneven. Those African economies that are more diversified with strong services, better manufacture and technology sectors are clearly outperforming others, while those conflict-affected and fragile states continue to weigh on the overall numbers. And also Africa's recovery still remains sensitive to vulnerable to FX stability, to debt dynamics, as well as climate shocks. However, for now, the recovery continues. And this recovery that we have witnessed over the last 3 years is being driven by three major factors. First is demographics. Africa has the world's youngest and fastest growing population, supporting labor supply, supporting consumption and long-term demand. Second is urbanization, rapid city growth, which is creating sustained demand for housing, transport, energy, infrastructure, and services. Third is reform momentum. Many African governments have been undertaking over the last 3 years difficult but necessary reforms, tightening fiscal leakages, liberalizing FX markets, modernizing tax systems, and generally strengthening institutions. Now, supporting these factors are additional resilience factors. First is the African Continental Free Trade Area-driven integration, which is deepening regional value chains and boosting intra-African trade. Also, widespread infrastructure build-out in transport, energy, and logistics across many African countries, which is crowding in private capital and lifting productivity in many African countries. Third is macroeconomic stabilization reforms, for example, like the kind that we're witnessing in Nigeria, which is improving policy coherence. And finally, despite the vulnerabilities of commodity tailwinds in recent times, it has benefited many key African exporters. So in summary, the continent has entered 2026 with an economy increasingly defined by selective resilience. Despite all the challenges in the global economy, Africa continues to grow stronger. But again, the point here again is that the strongest performance in the continent will concentrate in markets. And I've said this several times, and I probably said that several times throughout my presentation. It will be concentrated in markets that combine credible policies, consistent reforms, and sustained infrastructure investments. Next slide, please. With respect to inflation in the continent, it's also easing sharply. It has fallen from about 20% in 2024 to between 13 and 14% in 2025, and it's expected to trend towards 10 to 11% by 2026. This disinflation in the continent has been driven by four reinforcing factors. One is the monetary tightening that many African countries have started since 2022. Second, we now have more stable exchange rates for most of the countries in the continent, which is reining in imported inflation. Third is declining food and fuel pressures for many countries in Africa, and finally, gradually normalizing global supply chains, which are all benefiting the continent in terms of inflation. But that being said, inflation is still very high and above pre-pandemic levels, which limits the pace of easing. The good news, however, is that policy credibility is improving. Countries like Ghana, Kenya, Zambia already signaling cautious rate cuts, Nigeria also recently. And as we know, lower interest rates will support private sector credit, equity market valuations, as well as fiscal sustainability. Next slide. There are three other macro signals that also determine Africa's near-term trajectory. One is FX stability, second is fiscal consolidation, and then finally debt sustainability. With respect to FX stability, it's now considered the clearest test of reform credibility in many African countries. Currencies like the cedi, the kwacha, the naira, the Kenyan shillings have generally stabilized due to tighter coordination and improved reserves. And as we know, stable FX reduces hedging costs and attracts FX inflows. With respect to fiscal consolidation, the general trend across Africa is one of improving fiscal health. Debt to GDP is stabilizing high, but stabilizing around 70 to 72%, and deficits are narrowing. And as a result, Eurobond markets are cautiously reopening for credible reformers such as Kenya, Cote d'Ivoire, and Benin. Finally, with respect to debt sustainability across the continent, debt markets are shifting from crisis to selective opportunity. Eurobond issuances, for example, is estimated to have reached between 25 to 30 billion by the end of 2025, which is actually double what it was in a year earlier. But again, there are clear signs that investors are looking more for reform strength and not necessarily geography or market size, as used to be the case. So as we enter 2026, Africa's return profile will be shaped by policy credibility, to be shaped by FX stability, as well as fiscal discipline. Like I said again, those African countries reforming will attract more capital, while those that show little progress with reform would struggle. Next slide. Before I get into Nigeria, I want to stress another major structural development on the continent that I think is transforming Africa, would matter in 2026, and that's the EFCFTA. As a result of faster implementation of the EFCFTA, intra-African trade is expanding rapidly, and that again helps to reduce our the continent's reliance on the global economic turbulence. Custom processes have been harmonized, rules of origin have been standardized, logistic corridors are improved. There's still a lot of work to be done, but what I'm trying to say here is huge momentum in that area. I think African countries are beginning to understand that it's important for them to trade more with themselves, to partner more with themselves, to invest more within the continent, and that's helping the growth and resilience in the African continent. And we expect this to continue in 2026. South Africa, for example, that had been reluctant to adopt the AfCFTA, for example, is now moving quickly again because of the challenges it's having with its traditional market. So I think most African countries are understanding that, look, the only way the continent is going to develop is if it looks more inwards. And that's, again, going to be a pattern in 2026. So we are seeing clear value chain formation in sectors such as agro-processing, pharmaceuticals, automotive assembly, textile, digital trade, and so on. So as a result, the FCFTA is slowly shifting Africa's growth model from exporting raw materials to creating regional value chains. And that trend we expect to continue in 2026. Recently, I know some of you must have heard about the Gold Bank initiative partnership between Afreximbank and Egypt. The idea is to, rather than just exporting raw gold, Egypt wants to be the hub of actually gold manufacturing, similar to building an Egypt gold center, similar to what we have in Dubai. So we're having a lot more focus on value addition and not just exporting the raw material. So that's a trend that we're already seeing, given even Afreximbank, given the request we're getting from various countries. They want to do a lot more value addition. They're asking for more support towards industrialization, and not just simply to export the usual commodities that we used to for decades. Also, integrated markets are enabling scale in manufacturing across many parts of the continent, enabling scale in manufacturing, logistics, and distribution, in digital commerce, as well as regional supply chain. So those African countries that are, if you want to pick the African countries that will do better in 2026, will be those countries that are aligning faster with AfCFTA reforms. They will receive more FDI, and they will build more competitive logistics. They will be receiving more FDI and building competitive logistics infrastructure. Next slide, please. Another key determinant of performance in 2026 for the continent are climate events, which have now become major macroeconomic variables. Across Africa, climate shocks are intensifying. We have to note this. East Africa has experienced severe flooding. The Sahel is battling extreme heat, and Southern Africa continues to face drought conditions. Now, these shocks translate into real economic costs. For example, food inflation, lost productivity, damaged infrastructure, and the resultant increased fiscal pressure. Those divert resources to emergency response from development. But climate is not the only source of risk. Or rather, climate is not only a source of risk, it also creates an opportunity. Africa has some of the best renewable energy potential in the world, such as solar corridors, geothermal deposits, and major hydro opportunities. Also, climate finance is now one of the fastest growing channels of capital inflow to the continent. And we are seeing countries like Morocco, Egypt, Kenya, and South Africa already capturing large-scale investment in this regard. Nigeria is also beginning to emerge through energy transition initiatives, especially in gas monetization, distributed solar, and clean tech partnerships. So there's a huge opportunity to take advantage for Nigeria and Africa in this area. Next slide. The final slide on Africa. For the final slide on Africa, essentially summarize expected performance of the continent in 2026 by regions and key countries. I will not go into the details since they are on the slides, and in the interest of time, since we started quite late, I will just say that what we see is that You can see the table reinforces what I've said all along about performance being highly diverse. And that diversity creates very different investment entry points and tells us where capital is flowing and where. But the key message is again that as we enter 2026, the reformers, and that's what we are seeing if you look at this breakdown, the reformers um, will outperform. And it's those African countries that align policy with economic fundamentals that will attract capital faster, would grow faster, would develop faster, and would create healthier market macro environments. And importantly for Nigeria, its recent reforms, especially regarding FX and subsidies, are now restoring investor credibility. And if these reforms are sustained and deepened, they could reposition Nigeria more firmly back to the league of credible, investable African economies. And that process has already started. So now we can turn our focus to from Africa to Nigeria. Next slide, please. Okay, so Nigeria, next slide, please. Okay, so Nigeria's macro landscape is undergoing a fundamental transition, which I have categorized into four. First is growth momentum, which is stabilizing. Services and industry are driving expansion, while agriculture is recovering from weather-related disruption. So post-COVID, volatility is giving way to a more predictable 3 to 4% growth trend. Second, inflation is coming under control. Headline CPI has fallen from um, um, about 34% to about 80% in September. It's closer to 14% today. Although this was helped by a rebasing, which helped to, I mean, that brought down the inflation rate by almost over 10 points. So that was significant. But more importantly, Nigeria has delivered its first rate cut in 5 years, which is a meaningful signal of regained macro traction. Third, the FX reforms appear to be working. Unification has improved transparency and liquidity. Arbitrage windows are narrowing, and monthly FX volatility has dropped below 4%. Dropped below 4% on average in 2025, creating a more stable planning environment for businesses and investors. Fourth, structural reforms are reshaping Nigeria's external position. For example, domestic refining is reducing fuel import bills, and non-oil exports are gradually expanding on the AfCFTA corridors. So the bottom line here is that rising policy credibility plus structural savings from refining anchoring a more stable 2026 outlook for Nigeria. Next slide. So we will look more closely at the macro data, starting with inflation. Here we find that Nigeria is now firmly in a disinflation cycle, and projections point towards a 12 to 14% inflation band by 2020, by the end of 2026. In other words, policy transmissions worked exactly as they should. The central bank kept monetary conditions tight long enough to re-anchor expectations across households and businesses. And it was only after the official data showed sustained improvements that the CBN began to initiate its first cautious rate cut in about 5 years. Also, we see that core inflation is easing, although more gradually, and food prices are beginning to stabilize. I think the MD mentioned the drop in some food prices as logistics and security started to improve, although there's a slight reversal of late. And as bottlenecks also began to improve and planting conditions began to normalize. So what changed as far as inflation is concerned? First was FX stability, the foreign exchange market unification reduced distortions, narrowed arbitrage, and calmed speculative behavior. And once price discovery improved, inflation pressures began to unwind. Second was food supply recovery, better security, improved logistics, and the reversal of earlier import bans boosted food supply. Third was a more credible monetary discipline. For the first time in many, many years. Policy felt coherent, it felt predictable and anchored in data. Like I said, the central bank held firm long enough to send a strong signal that inflation control was a priority. Fourth, of course, was the rebasing and its associated base effects. As the economy moved past the shocks of 2023, 2024, base effects naturally supported disinflation. And also, like I mentioned, the statistical rebasing also shifted the starting point from the mid 30s to mid 20s. Like I said, that's a shift of 10 whole point, which is, of course, very significant. But perhaps or arguably the most important change was psychological. For the first time in years, Nigerians expect prices to stabilize. And once expectation shifts, behavior follows. Businesses will price differently, households will plan differently, and markets will start to respond more rationally. So why does all this matter? Firstly, for households, it means real incomes are beginning to recover. Secondly, for businesses, planning and pricing becomes more predictable. And finally, for investors, a stable inflation path allows the yield curve to flatten without risking FX instability. What does this mean as we continue into 2026? It means that with inflation expectations now being anchored, monetary authorities can finally move from pure defense to a position where they can begin supporting growth, investment, and deeper market development. So I expect the CB, the central bank, to focus more on growing the economy in 2026 and less on controlling inflation. I think that pattern has already gradually started. Next slide, please. With respect to GDP, Nigeria's growth outlook is also improving. Improving not dramatically, but steadily. Growth is projected around 3.7% for Nigeria in 2025. We'll confirm this when the final numbers come out. We expect it to rise towards 4%, about 4% in 2026, but this is assuming the reform momentum holds. Now, these numbers, like I said, are quite modest, but the point is that they represent a clear shift from the stagnation that defined much of the last decade. However, beneath this improvement, Nigeria's economic structure, and I've said this many times in the past, in different times I've spoken, it remains fundamentally dysfunctional. And as long as that dysfunction remains, it will be difficult for us to reach our potential. And that's the question that we should really be asking. Oil may contribute only 5 or to 7% of GDP directly, but it indirectly still drives more than 60% of economic activity, from government revenue and imports to exchange rate movements and investor sentiments. So in reality, therefore, almost 2/3 of our economy still responds to global oil markets. And this is probably why Nigeria has been stuck or was stuck in the 2 to 3% growth trap for nearly a decade. We know that the oil sector was in recession for most of that period. And as a result of that, Nigeria could not really move beyond that 2 to 3% growth because, like I said, over 60% of the economy is dependent on oil and oil. So if oil is in recession, the economy cannot really move strongly beyond that. So now that oil production seems to be stabilizing, oil export earnings seem to be improving. We're finally seeing momentum, with quarterly growth exceeding 4% for the first time in years. So structurally, Nigeria looks, or rather is diversified, but it's really only on paper. We have many sectors, but too few of them. Growth comes from many sectors, but too few of them deliver meaningful productivity or global competitiveness. So we are structurally diversified, but not productively diversified. In other words, we produce a lot, but too little of it is complex, value added, or tradable. And this is where our policy often misses the point. When policymakers talk of diversification, it's really frequently interpreted by policymakers as expanding revenue sources or widening the tax base, rather than addressing the true constraints to productive growth, such as poor infrastructure, unreliable power, weak logistics, issues with skills gaps, limited credit access for SMEs, and so on. But to build real resilience, Nigeria must move from extractive dependence to productive competitiveness, which it hasn't done yet. And to do this by strengthening value chains, supporting industrial clusters, and investing in human capital, technology, and infrastructure. Looking ahead into 2026, Nigeria's growth engines will increasingly consolidate around, in my opinion, five key sectors. First is ICT and digital services. For me, this will be the fastest growing driver, underpinned by fintech, e-commerce, broadband expansion, and maturing tech ecosystems. Second is construction and infrastructure, supported by both public investment and rising private participation through various blending, financing activities. Third is energy and refining, especially downstream activities in the post-Dangote environment, which is reducing fuel import and also creating petrochemical linkages. Fourth is agro-processing, which will benefit from the EFCFTA integration, to benefit from also improved logistics and emerging processing clusters that add value to staples such as rice, cassava, cocoa, dairy, and so on. And finally, fifth will be from continuous services recovery as inflation moderates and real incomes improve, boosting retail, transport, tourism, real estate, and professional other services. Now, these sectors together, to me, would shape a more stable and diversified growth path in 2026, helping Nigeria shift from volatility towards some form of sustained and broad-based growth. Next slide, please. Okay, so on this slide, what I try to do is apply our in-house macroeconomic forecasting model to kind of project Nigeria's GDP trajectory for 2026 under three distinct scenarios. The results show that Nigeria's growth outlook remains highly path dependent. Remains shaped primarily by all sector performance, at least in 2026, also dependent on reform credibility and global economic conditions. So in the optimistic scenario, as you can see on the screen, real GDP growth will rise to 5 to 6%, supported by strong oil revenues, effective and sustained structural reforms, tighter fiscal and monetary coordination, and a favorable external environment that stimulates investment and productivity in both oil and non-oil sectors. The baseline scenario, which I believe is the most plausible, places growth for 2026 anyway, places growth in the 3.5 to 4.5% range. Now, this reflects continued but uneven reform implementation, yielding moderate macroeconomic improvements, while persistent structural bottlenecks in infrastructure, governance, logistics, and human capital continue to slow the pace of expansion. Finally, under the pessimistic scenario, this is characterized by weaker oil prices, stalled reforms, heightened security risk, which is a bit of a concern of late, or adverse global conditions, which will result in growth decelerating to growth of between 2 to 3%. In this environment, elevated inflation, exchange rate instability, and subdued private investment will significantly constrain the economy's ability to generate broad-based and durable growth. Overall, these forecasts highlight what they do is they highlight the sensitivity of Nigeria's economic trajectory to policy consistency, to external shocks, and reinforcing the critical importance of sustained reforms to unlock the country's medium-term growth potential. So that's really the key question. How do we ensure that these reforms are sustained into 2026? Because if they are not, then all the gains that we have made in the last couple of years will be reversed and we'll put back in a worse situation. Next slide, please. With respect to FX, Over the past decade, the FX framework has moved from fragmented multiple window pricing towards a more unified and transparent market structure. As we are all aware, the FX unification has narrowed arbitrage opportunities, has improved liquidity distribution, has created a single reference rate that the market now trusts. So as liquidity deepened in 2025, monthly FX volatility dropped below 4%, as I mentioned earlier, signaling a more credible and functioning market and it attract a lot of more foreign portfolio investment in particular. Today, we are operating within a 1,450 to 1,550 naira per USD price band, which is wide enough to allow flexibility, but narrow enough to maintain stability. Forward and spot turnover has also increased meaningfully, and administrative windows have been simplified, reducing transaction friction in the process. So in effect, the market has moved from defensive management to a more genuine priced discovery, which is an essential foundation for long-term investor confidence and sustainable capital inflows. Next slide. Similar to GDP, we used our in-house macro model, and our latest projection places the USD to Naira exchange rate in 2026 at approximately 1350 on average by end of 2026. A central driver of the Naira 2026 forecast remains the strength of Nigeria's foreign exchange reserves and overall dollar liquidity, both of which influence market confidence and the currency stability. These are in turn heavily dependent on oil export revenues, which are still the dominant sum of FX inflows and a major anchor for Nigeria's sovereign ratings and portfolio capital inflows. Consequently, fluctuations in global oil prices and domestic production levels continue to exert outsized pressure on the currency, especially when oil markets weaken or if oil production is disrupted. Domestic policy choices, of course, also matter, such as monetary tightening, such as inflation management, such as fiscal discipline, and the evolution of the exchange rate framework by the central bank, all of which will collectively shape FX market outcomes in 2026. At the same time, Nigeria's high import dependence combined with high inflation, even though it's reducing, reinforces a feedback loop of rising import costs and additional currency strain. Layered on top of these domestic factors are the global dynamics. What happens to the US dollar strength? What happens to evolving investor risk appetite, geopolitical tensions, and a global recession risk, all of which could amplify or mitigate Naira volatility. Now, given these interlinked uncertainties, the Naira outlook remains highly sensitive to shifts in policy direction, to shifts in all market disruptions, to external shocks, and to domestic stability risks. So under our central scenario, a range of 1350 to 1450 per USD by the end of 2026 appears plausible. However, severe shocks such as the possibility of lower oil prices. I mean, we saw what happened in Venezuela recently, how the market is going to react to that, and what the US is going to do with all of that. All of this could push the currency beyond 1,500 in 2026, while successful reforms, stronger reserves, and improving FX liquidity could support a more stable outcome towards the lower end of our projected range. So we just have to be watching which of these conditions will dominate and prevail as we go through 2026. Next slide, please. Given the importance of reserves in FX stability, what I tried, the slide analyzes the prospects for external reserves in 2026 26 and 2027. Um, our, our model shows that Nigerian reserves are on track to gradually rebuild towards about 45 billion by the end of 2026, supported by stronger um, reform credibility and improving inflow channels. And three structural forces are driving this. First is import compression. As domestic refining expands and fuel substitution accelerates, Nigeria is spending far fewer dollars on petroleum imports as compared to the past. Every barrel refined locally reduces FX demand and could save billions annually, easing pressure on reserves and stabilizing the market. Second is export scaling and the formalization of inflows. Non-oil exports are gaining momentum, helped by agro-processing, manufacturing, and better use of the EFCFTA trade corridors. At the same time, the narrower gap between the official and parallel rates is encouraging exporters and diaspora remitters to bring funds through formal channels. So, with reduced incentives for diversion, more inflows now support the balance of payments. Third is restored investor access. As policy consistency improved, both portfolio and direct investors are returning. So this signals and a more predictable market is creating a more investable environment for Naira and Naira-linked assets. So what do these effects and reserve dynamics mean for 2026? For the policymakers, it signals a more credible macro framework. FX unification and the steady rebuilding of reserves mark a break from years of administrative fixes. So consistent rules and transparent pricing um, is reducing uncertainty and supporting long-term capital inflows. For investors, the stability is reshaping the risk-return outlook. So with lower volatility and better hedging options, investors are more willing to hold longer duration Naira assets based on fundamentals rather than short-term arbitrage. And for private investors, the more stable FX environment improves planning, it improves pricing and investment decisions. So import-dependent firms can gain cost visibility, while exporters and manufacturers benefit from local sourcing and deeper value chain integration. Next slide. With respect to the fiscal balance, our models expect Nigeria's fiscal deficit to narrow steadily from roughly 5.5% of GDP in 2024 towards 3.4% by 2027. And this is a result of the expected revenue improvements from the tax reforms and of course, the removal of subsidy payments. So subsidy rationalization, especially on fuel and electricity, is improving would improve fiscal space, while expected improvements in VAT efficiency and digital compliance systems I expect would improve non-oil revenue in 2026 and 2027. Next slide. Let's quickly look at Nigeria's debt and market access. Nigeria's debt to GDP ratio is expected to stabilize around 40% through 2026 to 2027, which looks comfortable relative to peers, especially with greater reliance on domestic funding, on longer maturities and seemingly improved liability management. The government's cautious approach to Eurobond reentry also supports sustainability. However, these headline ratios mask deeper risks. The pace of debt accumulation is a concern. It has significantly outpaced economic growth. This is okay in the short term, but if this continues over the long term, then all we're having is a situation where debt service burdens for Nigeria, which is among the highest among emerging markets, becomes a problem. Our interest interest is consuming a large share of our revenue. So I think I've always advocated that the growth in debt accumulation should be should to mirror the expected growth in the economy, plus minus a couple of percentage points. But as it is currently, the pace of debt accumulation is so much faster, it's going so much faster than the pace of economic growth, and that could be an issue. This means that for Nigeria, affordability of debt, not the size of debt, is the real issue. So debt, policymakers might cite a low debt to GDP ratio of 40% compared to the African average or emerging market average much higher, but that's not the issue. The issue for Nigeria is not the size, it's affordability. So while debt is unlikely to be a major risk in 2026, maintaining sustainability will depend on revenue mobilization. It will depend on what are we even using the debt for, spending efficiency, and disciplined borrowing over the medium to longer term. Next slide. I'll skip this slide. I think this is just talking about the improvements in oil output, which is helping the Nigerian economic growth. Also talking about the Dangote refinery and its impact on FX. And amount saving us roughly $7 billion in FX, helping to ease pressure on the Naira. This is going to be a game changer. I think it's not even the saving, or I don't even think the biggest story here is the how much FX we are saving from the Dangote refinery. I think it's more important. I think it's the industries that have been built as a result, petrochemicals, logistics, retail, and exports that have been created as a result of this move. Because I think together with growing renewable energy investments, I think this shift to define Nigeria's macro trajectory, not just in 2026, but over the next 10 years. Next slide. My final slide on Nigeria before concluding. What I try to do is to present a concise but expanded 12 to 18 months macroeconomic outlook for Nigeria using scenario analysis from our model. I've already discussed GDP and FX. So the objective here is to test how different combinations of oil output, inflation, FX, and policy decisions could shape the economy over the next 12 to 18 months. And as usual, I model them across three different scenarios: base, upside, and downside. In the base case, which I see as the most likely, GDP grows, like I mentioned, 3.3 to 3.7%. Inflation averages 14 to 15%, and the monetary policy rate drops slightly to near 20%. FX stays roughly stable around 1,400, 1,500 Naira to the dollar. Oil output averages 1.45 million barrels per day, and the price of Brent averages about $78. Now, this scenario describes a Nigeria of steady disinflation and cautious policy easing. The upside scenario assumes stronger reform payoff and faster oil normalization, in which case output rises to about 1.8 to 2 million barrels. Inflation moderates to about 12% on average, and the policy rate can ease towards less than 20%. In this scenario, FX will strengthen to 1,200, 1,250 to the dollar, and Brent prices firm near $90. These results are lower yields. You need renewed, stronger capital inflows and greater investor confidence. And in the downward scenario, this captures risk events: food or oil price shocks, FX slippage, where inflation rises back towards above 20%, growth slows to about 2.5 to 2.8%, and monetary policy tightens to around 26% to 30%. In this scenario, the Naira could weaken towards 1,650 to 1,800, with oil output dropping to less than 1.2 million barrels. In this case, liquidity tightens and confidence reduces. Each row in the table on the screen links assumptions with outcomes: GDP, CPI, NPR, FX, oil output, Brent price, and so on. The numbers are consistent within each narrative, and they move together, not in isolation. Now, below the table, I've tried to quantify what moves the needle. For example, every 1% rise in all output adds roughly 0.3 percentage points to GDP growth, or every 15 naira depreciation adds around 0.7 points to CPI through import costs. Now, this is elasticity remind us that oil and FX stability remain the twin anchors of Nigeria's macro path. We then translate those macro outcomes into policy and market implications. So as we can see on the screen, faster disinflation gives the central bank space to cut rates without destabilizing effects. On the treasury side, under the base case, the sweet spot is, I don't know, 3 to 5 year maturities, balancing yields and liquidity. In the upside, as yields decline, investors can safely extend duration selectively to lock in um, uh, capital gains. So in essence, this slide functions as a, should I say, decision support dashboard. The attempt to simplify our very complex macroeconomic environment to three plausible futures, so as to help both investors and policymakers see which levers, whether it's oil production, FX policy, inflation control, and so will most directly shape growth rates. It's how to take decisions, what to prioritize first. And this is the way more mature economists take decisions. And it only works in a better coordinated economic environment. That's one of the challenges we have in Nigeria. Before policymakers take decisions independently of other policies, and that's not the way it should work. Before policies are taken, the entire macroeconomic implication should be taken into consideration. If the central bank does this, how does it affect trade? How does it affect growth? How does it affect employment? And vice versa. But today, there's still a coordination challenge in the Nigerian macroeconomy. I think that's probably an area that I would recommend in 2026 is an area that the government should focus on in terms of reforms, ensuring that decisions taken are better coordinated. And at the end of the day, it's the net decisions are taken in line with the net benefits to the overall economy. That helps in terms of policy coordination, determining what we should do first and what is more important, rather than the way we did currently, where everybody's just trying to do what they think is best in terms of meeting their own individual independent mandate, which creates distortion and confusion and doesn't allow the reforms to be to work in a more coordinated manner and beneficial manner for the entire Nigerian economy. In conclusion, next slide, please. Next slide. Okay, so to conclude on Nigeria, I'll summarize the key points discussed. First is macro stabilization. First, Nigeria has entered a period of stabilization. Growth is strengthening, though still strong and fragile. We are seeing a declining inflation trend, which is creating room for cautious monetary calibration. Also, external reserves have improved, strengthening buffers against external shocks. And exchange rate flexibility, which is being managed carefully, is helping restore credibility and reduce distortions. However, the point here is that stability does not, we're in an era of stability, yes, but stability does not eliminate risks. Neither does it guarantee growth and development. It's really just the first step. Nevertheless, it does create the policy space needed for long-term planning and investment. But like I said, stability does not resolve the deeper structural issues that are persistent and well documented in Nigeria, which continue to prevent it from reaching its potential and exploiting the many gains from today's global asynchronous environment. For example, some of those structural challenges, which we're all well aware of, infrastructure gaps, they continue to raise transaction costs across the economy. Logistics, transport, power deficiencies, and so on. They quietly tax every productive activity, Also, energy constraints remain central. Again, we know all this, without reliable and affordable energy, productivity gains are going to be capped. There's a limit to how we can run until these things are solved, no matter how innovative firms may be, this is always going to be, it's going to be a restriction. We'll not be able to grow beyond a particular point, and that's always what has happened over decades in Nigerian economy. So all this has to be fixed. There's also a growing skills mismatch, a demographic dividend, risks becoming a liability if education and training systems continues to align with modern labor market needs. And finally, security and governance risks, which are gradually becoming a challenge. They do not just affect lives, they also affect capital allocation, they scare foreign investment, they affect risk premiums and investor time horizons. Now, all these challenges explain, like I said, why growth can occur, but it will be fragile and uneven, and people will tell you why they're not feeling the benefit of growth. For example, when you're computing GDP, assuming you have 1,000 uncompleted projects, in terms of GDP, the money was spent building half a road. So GDP goes up, but until the road is completed, the benefit to the public doesn't exist. So I'm just giving an example of how you can grow without any meaningful benefit to households or businesses. It's not if you build, you only work on half of that road. The road is not completed, but the amount spent on the road is part of government investment in GDP. So GDP rises, but then there's no benefit. People will tell you they're not feeling the benefits of the growth. So these are some of the issues that occur that makes growth uneven, fragile, and unfelt by the public. Now, addressing these challenges, however, also opens the doors to gives up to strategic opportunities. Next slide. For example, economic diversification remains central, reducing dependence on a narrow set of revenue sources. The digital economy and fintech offer scalable, exportable growth pathways. Agro-industrial value chains can also link agriculture to industry and exports. And Nigeria's creative and service exports hold untapped global potential. However, unlocking these opportunities require clear policy priorities. One is fiscal discipline and revenue mobilization, which are essential for credibility and sustainability. Second is infrastructure investment, especially through public-private partnerships, which must be accelerated. Third is human capital development, which is, like I said, is non-negotiable, especially in today's technology-driven world. And finally, institutional reform, predictable rules, credible enforcement, and policy continuity, which are all very important and help reduce uncertainty far more than incentives alone can. But government action alone is insufficient. Policy alone is insufficient without private sector leadership. It is capital formation that will determine whether Nigeria's growth ambitions are realized and whether we can meet our true potential. Policymakers tend to focus on foreign capital. But the truth is, long-term domestic capital is as important as foreign inflows, arguably even more important. Also, innovation and productivity improvements, especially among SMEs, are critical for competitiveness and job creation. Similarly, regional value chain integration offers scale. Nigeria cannot grow in isolation. It must anchor and benefit from West and Central African production networks. And finally, sustainable finance are key these days. These days, access to capital, cost of funding, and global credibility are all very important. And all of this requires adaptability because the growth path ahead, as we have seen, will not be linear. So what does all this mean for Nigeria in an asynchronous world? Next slide. First, there is no one-size-fits-all policy path. What works for one economy may be destabilizing for another. What works for one sector may destroy the other. Second, adaptive strategies matter more than rigid frameworks. In this regard, policy agility becomes a competitive advantage. Third, domestic resilience, whether fiscal, financial, or institutional, is the shock absorber in such an environment. And finally, strategic positioning matters. Nigeria must align selectively with global shifts rather than just react to them passively like we always tend to do. This raises critical questions for 2026, which I believe will form part of the panel questions following my presentation. I have raised a few, next slide, and I've raised a few of them. First, how do we sustain reform momentum? Very important. When the political and social costs are front-loaded, but the benefits are gradual. In other words, how can policymakers maintain public and political support for reforms when people are feeling the pain and they cannot see the benefits, especially since the benefits would come much later. How do we, especially and when you are going to an election period when, because of votes, policymakers might tend to slow down on reforms or even reverse some of the reforms in the interest of winning votes. It's not a Nigerian problem. It happens everywhere in the world. In many countries, you see government stopping some controversial policy until after elections. But in Nigeria, it's a bit more, it's taken a bit more seriously. So how do we continue the reform? Because if we stop the reforms or reverse them just because elections are coming, we'll literally be starting and resetting. And then the pain, you've gone past 40% of the pain, then you just start over again, which is not what we want. Second question, how do firms and businesses hedge volatility, not just financially, but operationally and strategically? Thirdly, how do we unlock long-term domestic capital in particular in an environment conditioned by short-term uncertainty? And finally, how do we translate growth into jobs at scale and sustainably? I think I'll end here and once again thank First Bank once again for inviting me to deliver this presentation, and all participants for patiently letting me get through my presentation. Thank you once again.
Thank you so very much. Can we do it better? I mean, you have to agree with me that that presentation was not an abstract conversation, full data backed with economic templates and models, giving us scenario-based possibilities of what the economy would look like. Can we do a better job in appreciating Dr. Kale? I would have loved to do a recap, but we're pressed for time. So at this juncture, I'm not going to bring up on stage because we still have a lot of conversations and experts in the room. I mean, I love the way that they ended with the strategic questions to answer. There are experts in the room who are going to take a jab at answering those questions that we can take, action points away from in the room. Please permit me to bring up on stage the Head of Strategy and Corporate Development, First Bank of Nigeria Limited, Mr. Chike Uzoma, who is going to moderate the panel session. Please do it better as it comes up on stage.
Thank you. Thank you so much, audience. We are going to go into the panel session. Dr. Kale had laid the ground very well for us to get into the key conversations. And as a bank that is woven into the fabric of the society, a bank that puts the customers first, we want to prepare our customers as we start a new year. So we've assembled great experts and professionals across various walks of life, across various knowledge domain, across various industry verticals, to drill down more into sector-specific insights from what Dr. Kale has done. So, in no particular order, I would like to invite our erudite panelists, starting with Professor Bongo Adi. Professor Bongo Adi is a professor of economics and data analytics. We are in an era where data is the new oil. So, Professor Adi will be helping us create more insight into what organizations should do. I also invite an in-house expert, a relationship manager par excellence, an advisor to corporate clients, in the name of Osahon Ogievra. Osahon has had extensive experience in corporate banking, in relationship management, in advising clients on how to break grounds, enter into new sectors. So he'll be sharing some of those thoughts with us. Osahon, you're welcome. I have an expert that is joining us virtually. The name of Francis Anatogo. Francis is the CEO of Trans-Saharan. He used to be the executive secretary of the Presidential Committee on the Implementation of African Free Trade Agreements. Francis is joining us online. Please, can we beam Francis online? While they're doing that, I will invite, you see, the tax reform has taken effect. There are still several questions to be asked. And because we want our customers to be educated, we want our customers to be well prepared as we implement the new tax reform, we brought a very interesting and well-knowledgeable expert in tax in the name of Kenneth Erikume. Kenneth is a partner, tax reporting and strategy for PwC. And behind the doors, they also knew how the tax reform was crafted. Welcome, Kenneth. You see, we are getting into a world where digital transformation defines almost everything, where governance principles are the key to accelerating and building resilience. So I have a transformational leader within the technology and digital space, and I'll bring in Ni Yusuf, the managing partner, Veraki. He used to be the country managing director of Accenture Lagos. Welcome, Ni. And also, he's the chairman of Nigeria Economic Summit Group. So he's into significant economic analysis. Coming up more, it's Laura Fisayo Kolawole. Laura is an investment expert. He brings to the table significant advisory capabilities within the alternative investment solution and equity market. So Laura will be sharing with us significant thoughts around the investment horizon. I will also have another panelist online. Cheta Wenze is joining us online. Please, can we beam Cheta? Cheta Wenze is the founder and CEO of SBM Intelligence. SBM Intelligence and Cheta drive significant economic insights within Nigeria and Africa. So he will be bringing that word of knowledge to us. I'll also bring in an economics par excellence, a strategy professional, Olusegun Zaccheaus, is a partner and chief economist of PwC. So that's the experts that will be walking us through some of the specific sector insights. Two virtually joined with Dr. Kale, who will be taking questions from the audience that are joining us online, as well as questions from some of the audience that are here. I will kick off with some of the questions we've already obtained, and we go through that. We'll make this very insightful. We make it very, very, very smart, so that we can get done with most of the things we want to do. So taking some of the questions we already have coming from the virtual attendees, I'll start with Dr. Shegun. Shegun, very, very interesting question coming from some of our audience. This is Shegun. With PwC's global vantage point, asynchronous growth implies some economies will thrive while others will stagnate. And Dr. Kale did mention that. For a Nigerian business executive in this room or online, what are the 2 or 3 most critical signposts in the global economy in 2026? The business must monitor that would disproportionately impact Nigeria, as well as make the decisions of the business very decisive. That's a question for you, Shiku.
All right, thank you. Good morning, everyone. And good morning to the customers and people online. I'm happy to be here. I think that's an excellent question, Chike. And if you ask me, what are the big 3 things that every business leader should be paying attention to from a global landscape, right? I'll say one, right, is the global macro development, especially as it relates to financial conditions in developed world. What do you mean by that? Essentially, check where the rates are going, right? Because it will really determine how the general condition in the world will be. And let me explain why, right? You look at US, for example, there have been conversation around easing the rate. They're going to have a new Federal Reserve president sometimes this year. And the whole argument is like, oh, you should have actually reduced rate. But you also then get the argument that we're getting into a recession, right, within the US, right? So the conversation around rate will be an important point to sort of follow, because it sort of determine how global capital will move. And an example is, if the rates remain lower in the advanced economy, what happens is that you see more capital coming to this part of the world, right? Also linking back to what Dr. Kale said, if we have the right policies, right? So for me, the first point you must pay attention is, what are the global interest rates saying? And essentially, what are the global central bank, Bank of England, Federal Reserve, European Central Bank, what are they saying around rate? That's the first point. The second point we need to pay a lot of attention to is the dynamic of OPEC Plus, right? OPEC Plus is the cartel that determines what oil price or production will be within the global market. And this is very, very important. And one of the examples you should pay attention to is that if you look at what happened in Venezuela recently, right, it has significant impact on the dynamics of oil price, right? But the reaction of OPEC or OPEC Plus, which if you include Russia, will also be very important. And as we have highlighted, oil price production direction will have significant impact on Nigeria economy. I think the last point I think we must all pay attention to is the issue around how technology is being played out. And Dr. Kale made a very important presentation around AI infrastructure, how would that develop, etc. and all that. I think every business here must pay attention to how that dynamics even shape up globally and even in Africa, because this will also affect how AI productivity will become mainstream within the context of Nigeria and Africa. So in summary, 3 things to look out for: global interest rate, oil production and price dynamics, and how technology will shape up the economy in 2026.
Thank you so much, Shegun. The audience, please, if you have a question, either you can write the questions and pass on to us. We can take them, or you can raise your hand. We'll give you an opportunity to ask the panelists some questions. Also, I will come to you right now. I know you are an experienced relationship manager, a banker par excellence. Now, in your view, for large businesses who are also joining us across several sectors, you have a unique dashboard of view as a relationship manager who packages facility for customers. How would capital allocation, sectoral health, corporate vulnerability affect your decisions to determine the customers you're likely going to support going forward? In this era of recalibration, I also want you to let us know what are the defining characteristics you are looking for in 2026 when assessing which companies and which sectors are truly resilient, because Dr. Kelly did mention resilience as one of the key factors going into 2026. Businesses countries need to build resilience. Now, and so how would that affect the creditworthiness of those customers as you assess them versus those who will simply survive? More pointedly, what strategic moves are the most resilient corporate clients you see talking about today for 2026?
Thank you very much, Chike, and thank you, audience here in person and those online. Very happy to have you all with us this morning. So on the subject matter of resilience in this year, 2026, it's really not about who is growing fastest. It's about who can fund growth on a bad day. And, you know, it's an election year. And every time you have an election, there are many unknowns. Because politics in emerging market countries come with a whole lot of surprises. So from where I sit, companies that do well at volatile times like this have 5 characteristics. And I would just like, because we have many of our clients and customers here, what we'll be looking out for. The first thing is how disciplined your cash flow management is. What are your conversion cycles? At a time like this, we want to know how you handle the things that matter. Cash is king. We also want to know your revenues. Are they episodic? Are they one-offs? Or are they repeatable? We are interested in companies that generate sustainable revenues. We are interested in supply chains that are flexible under stress. One of the things Dr. Kale had said is the lack of infrastructure. What that means is you need to have systems that are ready for the unknowns. Another thing that we're looking at is your business. Have you put in them natural hedges? Do you have, and the hedges now are just not financial hedges. Do you have hedges for power? I think it was very clear from that presentation that the best companies are companies that are not waiting for Genco or Disco to give them power. There are companies that have conquered the Genco Disco stories. They are generating their own power, most of them, or signing power purchase agreements with independent producers of power. It's continuous production. You can't tell us you didn't make your cash or your revenues because Disco did not give you power. Nobody's listening to that kind of discussion in 2026. So you're securing the capacity to remain in operation under the most severe condition is important to us as we analyze your business. And then governance. We are very huge on governance. We want companies that are reporting governance not in quarters, but in days. Companies that will succeed, companies that we are partnering with, are not just surviving shocks. They are anticipating them. They are having trigger-ready playbooks. If this doesn't go right, we do this. You are ready. You have done all the scenario planning, and you are ready to go. So at First Bank, we are backing businesses that show and demonstrate that they understand the opportunities in an emerging market like Nigeria. We are seeing companies in the FMCG space shrinking pack sizes to compensate for purchasing power. We are seeing healthcare firms doubling down on compliance and cold chain integrity. So when you see some of the big pharmaceutical supply systems, their medicines are a little more expensive. But go into that pharmacy, there is solid air conditioner working there. You go to MedPlus, the price is going to be a little higher, but the medicines are also better preserved. That's what we are looking at. We are looking at people that can tell the story from the pressures that they see. We are seeing many logistics providers coming on board, people who are specializing in small aspects of industrial complexes, whether it's just providing independent power, whether it's just providing the trucking system through the rail systems. We are seeing a lot of opportunities coming in those areas, and we are supporting those kind of people. So the most resilient clients are already executing bold, practical strategies. They are engineering working capital through receivables discounting, locking in index contracts. So in some industries, they are ensuring that their pricing is tied to their supply contracts. So if it's moving at $10, they already have the Naira equivalent tied to the contracts. So as you have devals, you are paying the new price. And those are the kind of companies we see. Those are the kind of things we see. And those are the people we are supporting. So at First Bank, not only are we seeing this, we are sitting on the table with these clients and are providing real-time, ongoing advisory. We are making available the huge intellectual capital that the bank possesses to help our customers to navigate the uncertainties of the emerging world. And one of the most important things I took away from Dr. Kale's intervention is the amount of power we need to run the AI world. We already know that in Manhattan, Mark Zuckerberg is building data centers for $500 billion. We will need that capacity of data centers in our country. I know about 2 big data centers going up now, but we need a lot of that. To run those data centers, we will need a lot of power. So we see the opportunities, and we are waiting for our friends and clients to come sit with us and discuss how to take these opportunities forward.
Thank you so much, Osaho. Very brilliant response. Again, one of the things he did mention is First Bank supports businesses who are resilient. And we don't just leave businesses to also build resilient capacity. We support businesses to build those resiliences. And that's why today we're bringing insights, we are gathering experts to ensure that businesses get the real insight they need, get the drivers of today's economy, and use that to prepare. And offline here, people like Osaho and some experts we have in the room from First Bank are always guiding and advising clients and customers on what to do to remain resilient. Kenneth, I will come back to you right now. The tax reform is already implemented. We can't go back. But at First Bank, we like to prepare our customers to surmount the challenges. Now, today, several finance teams in several companies across several sectors are asking questions. In your view as a tax expert, what kind of advice will you be giving finance teams on how to update their systems in view, their ERP system, payroll systems, and so on, in view of the changes that we are going to see, we are seeing already that has been articulated in the Tax Reform Act around compliance? How do they ensure that they pay the required personal income tax? How do they ensure that the systems are enabled for the e-invoicing reform? How do they ensure that they comply across both the federal tax authorities and the state tax authorities? Our customers would like to get those kind of guidance and insight. Thank you.
Thank you, Chike. And that question is very deep. And the reason why I say that is, first of all, if they are trying to comply now, it's almost too late, right? Because the law is already in full swing, started 1st of January. And many people had to change their systems long before now and waiting for go live. And go live was essentially 1st of January. Now, if you haven't done that, I think there's no cause for alarm yet, because most of the filings that need to be done wouldn't have been done by now. So you still can go back and check your systems. I think the most pressing and urgent one is the payroll, because at the end of this month, you have to pay your staff. So essentially, the logic and the rules in your payroll system have to be updated with the new rules. Exemption up to 800,000, and then the other rates begin to kick in. And then if the person is earning any portion above 50 million, that's taxed at 25%. So it's a graduated scale. What we've seen is that, without any significant reliefs being taken by the staff, anybody earning below 25 million, their take-home pay would increase because the taxes they pay would reduce. Anybody earning above 25 million, their taxes will go up, meaning their take-home pay would reduce, right? So from a human capital perspective, and this is not just systems, you also need to think of how you manage that differential. The staff will be taking take-home pay. Obviously, you can't claw that back. But the staff earning above 25 million, is the company going to absorb some of that cost by doing a payroll review to coincide with that change? So fundamentally, I think the payroll is the urgent and most pressing and has to be dealt with immediately. The other is the transaction taxes. Transaction taxes are largely your withholding tax and your VAT. The one where the rules have changed significantly is for the VAT, and there is huge opportunity there. And this is something I think the customers need to be aware of and take advantage of. For every company in Nigeria today, your costs can be reduced by 7.5% because you now have an extended ability to claim the VAT on your expenses, right? Before, it was only manufacturers on their goods they buy to resell or goods that they buy to manufacture. Now everybody can claim the VAT on their costs relating to their fixed assets and their overheads. When I did this analysis and I use PwC as an example, the benefit we were going to get per annum was above 500 million naira, right? And that's value going into your profit or loss account immediately. But we have to update the systems to be able to recognize that. So you don't expense the VAT on your cost again. It goes into your VAT account as an asset. And then when you charge your customers, you knock it off when you're filing your VAT return. So that's the second urgent one, which I think is really massive in terms of benefits. And then there are lots of things that you need to do around processes as well. The first one is there's this rule that says if you transact with someone that has no tax identification number, you can be penalized for up to 5 million naira, right? So you need to do an update of your vendor validation process to ensure that if you're onboarding a supplier, that person provides a tax identification number. The question I usually get sometimes is, what if it is a roadside vendor and you just want to repair your car and get the reimbursement from the company? Of course, you have to ask the person for their TIN, otherwise you'll be in trouble. So this means that you obviously have to now start patronizing artisans that have tax identification numbers versus those that don't have. And I think the final one is there's huge penalties because there are lots of things to say, so I just keeping it to these main ones. There's huge penalty for missing the rates, under deducting or not remitting for withholding tax. So government can basically do nothing and just get additional 40% penalty from you by wrong deduction and payment of withholding tax. So if I were to advise people, it is to automate those processes that these new laws bring huge penalties on or impose huge penalties on. Because in those areas, getting it right the first time without any errors is actually critical and important. And you do not leave it to human error. So automating those processes becomes crucial. Working with the IT teams, not just the finance teams, to ensure that you use state-of-the-art systems to implement would be key. Final comment on this is whatever logic you're doing, ensure that it is the final version from the National Assembly, because we have seen different versions. So just go back and check that, okay, this is the final version. Thank you.
Thank you so much, Kenneth. That was quite insightful. And please make sure that you recheck and check again that you're operating with the right version. Because penalty for operating with the wrong version is very huge. So, Nia, I'll come to you. I have an interesting question for Francis. Please, Francis, start preparing. But before you come on board, Nia, I have an interesting question for you. Recalibration often necessitates technological leverage. Beyond just adopting tools, what is the core operational or business model mindset that Nigerian companies, especially those in the traditional sectors, must abandon in 2026 to master resilience? And what should they replace it with to capture the value of the new asynchronous era? What an interesting question from an audience. Niyi, please help us.
Thanks, Chike. Your question speaks about mindset. And I think the last 2 or 3 slides from Yemi, it spoke about the implications for businesses and for government. It talks about innovation, role of technology, and productivity. And I think if we focus on just innovation and productivity, I think one major mindset that we want to shift from in this year is move from being rigid and to becoming adaptive. The shift from just focus on a transaction-centric view, and then you focus on a customer solution. Because reality is there will be shocks, there will be volatility, but the needs of customers will continue to be the needs of customers, right? They like to transfer money, they like to get credit, they like to make some consumption, some procurement, housing, etc. And so those needs are basic. If you understand the National Housing Expenditure Survey, realize that food, accommodation, clothing account for well over 56% of the average spend. And then when you add transportation, health, education, that's well over 80%. So those needs will continue. And so I would say let's shift from being rigid to becoming more adaptive. Let's shift from focusing on transactions or a fixed idea to focusing on customers. What are the needs of these customers, and how can I then flex myself to be able to meet the needs of these customers? And in flexing yourself, what I find useful is just, being comfortable with the construct of the and, so that you don't push yourself into making forced choices. So be comfortable with and. Things can be affordable and can be of high quality. You can be bold and take bold moves without necessarily having all the data validated. Right? You can be fast and still be accurate. You can be of good service and still be not that expensive. No, you can be consistent and still drive change. And so if we focus on the concept of and, we realize that you can thrive even in a volatile environment. And I think if you have that mindset shift, then companies and I'll say human beings can be better placed to thrive in what is looking to be a very volatile year.
Thank you so much. Mindset needs to change. our customers, the businesses we support, are businesses that operate with a growth mindset, the mindset to thrive even in a volatile environment. Francis, please confirm if you can hear me now, because I have an interesting question for you from an audience.
I can hear you. Can you hear me? Good
Excellent,
morning, everyone.
Francis. And I will try to read it verbatim from the audience. It says, Francis, you've been at the heart of Nigeria's African Free Trade Agreement implementation and strategy. Given the theme of recalibration, what is the single most consequential policy or infrastructure adjustment Nigeria must make in 2026 to shift from being protective market to a competitive powerhouse within the Continental Free Trade Agreement? And what is the first step, an export-oriented, very importantly underline this, what is the first step an export-oriented business that is here or online should take to ready itself to benefit from the shift? Francis, this is your turf, so give us the insight.
Thank you very much, Chike. This is a multi-barreled question. I think I'm thankful that Yemi and Osaho came before me. I think to answer that question, let me just step back a second and set some kind of if you say operating principles. I think the very first thing that I'll say is, what are we trying to achieve? One of the key words in your question is becoming a powerhouse. And when I think of becoming a powerhouse, a couple of, from export perspective and AFCFTA, three things come to mind. Two is the certainty, predictability. And the third is speed. I mean, all of these things drive competitiveness, and you can't actually think about export trade or AFCFTA without these three things. So if we say that what we are trying to achieve is the scale, certainty, and speed, then the question comes, so how do we recalibrate? And to answer that, I struggled to come up with one, but I'll give you kind of different aspect of the same of what we need to do. I guess the key word which Yemi mentioned and Nii mentioned is being adaptive strategy. When I hear adaptive strategy, what comes to mind then is, can we get on with execution, please? Can we execute at scale? Why? Because we have the basic strategies already in place. Like you said, Nigeria was one of the first to put the AFCFTA strategy in place. And back in 2022, it hasn't really been fully adopted and implemented the way we designed it. But in that strategy, we recognize some basic truth, right? One is that export is really about domination, right? It's not about playing. It's not just about going into market. And you don't need to look beyond China and critical materials to understand the power that comes from dominating. But what that also means is that you have to be selective. You can't chase everything. You have to resolve to say these are, and I mean, yeah, these are the areas where I will play. Not only where you have today's competitive advantage, but where you intend to build competitive advantage in the future. So future-proofing your economy or your business. Now, but you now need to bring that closer to our realities, which we talked about, the structural imperfections, the roads, logistics, the size of our SME, which is small. And the size of our SME is actually quite means that you're thinking about the people you are thinking about people that are struggling to make ends meet, and you want them to export. It will be difficult. So with that in mind, one of the things that we um, uh, define as a way forward was aggregation. And aggregation might sound abstract, but really it is about uh, um, kind of working in clusters, be it production clusters, logistic clusters, and other areas. And when I was listening to Osaho and what he's looking at businesses to do, and he talked about power. So not every business can afford to go and sign a power agreement. But if you as a business, maybe a middle-sized business or even a smaller sized business, take what he said and say, okay, how do I solve this within the limit of what I have? Then you now start thinking of clustering. Now you now start thinking of aggregation. But that also means that you need a new class of businesses that will focus on aggregation, um, because there is value there. There is opportunity there as well. The other thing that businesses also need to think about is, greenfield is fine, but how do we extract multiple layers of value from the same single product? So today, we've got businesses, banks all over Africa. So they've made the investment, they're already there. How do I leverage their presence there? We already are big in fintech, we already are big in telecoms and a number of other sectors. So how do I plug into what already exists? So in a nutshell, in terms of the strategic fit is really about skill, right? Coming together in clusters, focusing on bigger, better run arrangements and more financially stable arrangements that could enable you to export on your own if you can, or work with others to export together based on what you have. So the word specialization also came in, because then if you can focus on your own little area and be the best that you can be, and work with others and be the best that they can be, then you will then be able to export. So that is one strategic fit, that a shift that we need to work on. Focus on skill, be part of skill. The second one is really about it talk about speed and certainty. Now, certainty in terms of approval, this is more in the policy space, certainty in terms of approval, certainty in terms of verifications, certainty in terms of border, because truly anyhow may work in Nigeria, but anyhow will not work in the export space, not even the AFCFTA space. So understanding the requirements, and actually making sure that you have what all the requirements and the bid compliance requirements and so on will it's something that needs to happen for businesses themselves. But as government, one key area that we need to get right is get the single window platform working. That's a major government initiative, but as part of that central government initiative, there are private businesses in the technology space that are doing one thing or the other, whether it is in verifications, approvals, or document control, or what have you, to bring all these things together. So really making sure that approvals happen once, can be verified, can be viewed at convenient in real time, and the ports work, and you are certain that when you order a product, it will come within so period. That is a critical shift that needs to, or recalibration that needs to happen. There is the third one, and I'll stop at the third one. The third one is I would call it the mindset change. So we all know Nigeria as a big economy, right? The market is big, and a lot of businesses have the mindset of, oh, I have not been able to satisfy the local market. Why should I bother with more stressful export? But then, two things you need to bear in mind. One is that if you look, just go and take a look on, talking about Forex exchange rate, go back as back at 1990 or even 2000 and come to present day. What you find is that every 3 to 5, maybe 6 years, you have a massive devaluation. Now, that's not going to go away immediately because our economy is still heavily reliant on oil. So, and that's what is the major cause of that devaluation. So, from a wealth preservation perspective, you need export exposure. So, the mindset that you can grow in Nigeria alone is fine, depending on your sector, is fine. But really, there are easier, if you want to future-proof your business, you should think about market diversification. In my mind, and when we started talking about this in 2022, we didn't know the massive exchange rate correction was going to happen in 2025. But we were talking about, we saw it and say, hedge, hedge, hedge through market diversification. It helps you in terms of your liquidity. It helps you also in terms of your operational flexibility, and also, yes, the Nigerian market is big, but it's just about 10% of the African market. And I don't know what percentage it is of the global market. The capability you need for export to Ghana, to South Africa and co is what you need to also extend to other parts of the world. So in essence, these are the three things that I would say. So focus on execution. That's one real recalibration. Focus on scale and domination, where, even within your businesses, but even as a country, where can I grow? Where can I be the best possible in Nigeria, in Africa, and potentially the world? And the third part, where who will I work with to achieve that? And the last part is really in terms of the speed and certainty, which is more in the government domain, but still a key recalibration requirement, in my opinion. Thank you.
Francis, that was quite revealing, and I want to believe some of our customers have picked some tips on how to expand or go into export-oriented businesses to harness the opportunities that are there. But I would like to just inform some of our customers who are still thinking, who are still reviewing, that at First Bank, there is an expert export business desk. And that desk is staffed with people who understand how to harness export opportunities. If you've not started having conversations with us, please reach out. The interesting thing is that that same business team have established significant strategic partnerships with institutions that either regulate or promote export-oriented business. So we can take you to the door. We can show you the path to harnessing export-oriented businesses. And it's very important that that mindset shift, like Olaniyi and Francis did mention, starts from today. Engage First Bank's export business desk, and you're quite covered. and the rest will be for your advantage. Prof, I'm coming to you, but Cheta, please get ready. I have an interesting question for you. So please, can we spotlight Cheta, because the next question after Prof is going to go to Cheta. Prof, there's a question here. You know, nobody knows better than a professor. And when somebody is a professor of economics and data analytics, and in an era where we say data is oil, our online audience are quite interested in understanding, getting insights from Prof. Adi. Prof, I will try to read what I got from an audience. It says, data is the compass for navigation. And that is pretty straightforward. We understand for you to operate in any sector, for you to operate in any business, you need that navigator. And data is it. But don't just raw data, but the insight that comes out of that. So he says, the question then says, in an era of asynchronous growth, which unconventional or underutilized data set should Nigerian executives be analyzing in 2026 to gauge true domestic economic health, consumer sentiment beyond traditional GDP and inflation figures, and why should they be focusing on all those unconventional data sets?
Significance is that it is forward-looking, it's not lagging. Now, traditional macroeconomic indicators lag reality by at least 90 days. In Nigeria, it's actually more. So for any executive to really read the true runes of the market, you really need some forward-looking indicators rather than lagging indicators. So PMI is one. Another one I think is underutilized is the electronic money transfer data. I don't think we also have, found ways. Yes, I know the what's this agency now? They publish some bit of that data, but I think it's something we still need to partner with some of these the banks. I think you're there. The Money Points, the PayPal, all these new banks. So most of the informal businesses have such accounts. So knowing the volume of transactions and ticket size is very crucial to understanding the market. Then the other one is the last mile logistics. Again, we do not have sufficient data there. For instance, when people reject parcels or packages, we don't have data because that's also another way to gauge the consumer sentiment, the true confidence in the market. Yeah. So so those are some of the, will I say, non-traditional data sources that I think businesses will need to rely on to make proper decisions going forward.
Thank you so much. While Cheta is getting ready, Cheta, please start getting ready. Laura, I have an interesting question from an audience for you. Again, given that you work with one of the foremost asset management firms in Nigeria, First Asset, a subsidiary company of First Holdco, and a sister company to First Bank. This is an interesting question that an audience is trying to get some insight around. And I will try to paraphrase what the audience is trying to say. With capital being very selective in recent times in a divergent world, where are you advising your clients to place strategic bets in the Nigerian market in 2026? Again, we're in a new year. People are trying to weigh their options around where to put money, where to place bets to get optimal returns. And it says, are we looking at a year for a defensive equity position, alternative asset plays, or is there a specific sector you believe that is fundamentally mispriced for the growth that it can deliver?
Thank you, Chike. Okay, so I think in terms of Nigerian equity, and I think it's a lovely question that you asked. One of the very first things that Segun said when he started speaking was the global economy, we're seeing a world where yields are likely declining, at least that's the broad view. And so capital is going to look to flow to hopefully frontier markets. So that is one backdrop in which Nigeria is featuring. A lot of Dr. Yemi's presentation talked about the fact that there's a macro recovery. That macro recovery means that as capital is looking for a home, a place like Nigeria is potentially looking like a good home for capital. Nigeria is also benefiting from disinflation. If you remember, I think it was December 2024, where inflation was 34.9% or something like that. And we're now at 14.45 latest reading. So falling inflation, improving purchasing power for consumers, just a broader, better business confidence. This is really the backdrop that we're looking at for this year. And, we're looking for a broad recovery in Nigerian equities this year to continue. So when you look at earnings momentum, I think last year, earnings growth on the NGX was almost double, right? Broad-based. And we think that will continue this year. So from a broad sector perspective, and I'll talk about sectors a bit more, but I can imagine that the one thing that, you'll have some skeptics who will say, well, Nigerian equities have done very well over the last 3 years. And they wouldn't be wrong. So if you look at 2023, equities were up, I think it was like 45%. 2024, 37%. Last year, 51%. So these are huge nominal numbers. And so the question is, can equities really perform again this year? Even though you would naturally expect that as the monetary policy is being eased, that is positive for equities. And we're actually very constructive on equities this year. We do think that it will perform quite well because, for better or worse, even though we've had very strong nominal performance, we look at underlying earnings growth has still been very, very strong. So when you look at Nigeria's PE ratios, which is a measure of, I guess, the value of Nigerian equities, the PE ratios are trading at relative discounts when you compare them to African peers. So Nigerian, I think the NGX PE is currently about 6.1%. The PE of the Ghanaian stock market is around 7.7 times. Kenya is 7 times. I think Egypt is about 8.7 times. So you can see that Nigeria at 6.1 times is actually cheaper. And so when foreign investors are looking for a home for capital in, on the African continent, Nigeria should feature as a place where there is value. And so when you then have, I think we had the whispers last year from Russell, from the FTSE Russell, that said it was looking or had put Nigeria on the watch list to potentially have her added back to the frontier market index list. Again, if that happens, that really just attracts foreign capital into the Nigerian market. So these are really all tailwinds that we think will support equities this year, even though we've had very strong performance coming into this year. And from a sector perspective, I think for all of us, because I think this year, one of the things that Mr. Yemi spoke about was the fact that equity performance has become, has really blown up, and people are looking for Nigerian equities, and people want to invest. And so from a sector perspective, I would talk about 3 sectors broadly, the banks, industrial goods, and consumers, as places where anybody who's, has a few naira saved that we're thinking of what to do with that, please put your money in those sectors. So, for the banks, the macro recovery is positive for banks. And one of the great things that has happened recently is that the banks are raising capital. And that capital raise should ideally be channeled into loan growth, which again helps net interest income. So this is a space that we expect to see earnings momentum continue going into 2026. And when you then find that quite a few banks have very strong ROEs and have very good cost management, which again should feed into profitability. So for us, we like the banks broadly. We like the industrial goods sector, so in particular the cement producers. If you have a few spare pennies, please invest in the likes of WAPCO and Co. Because we do think that the sector, it's benefiting from just lots and lots of undersupply. So when you think about the infrastructure deficit, Dr. Yemi spoke about it, I think we can all appreciate the infra deficit in the country. Sectors like cement are really there to plug that deficit. And it's a space that the macro recovery, improved purchasing power, again, should benefit. And the last sector I'd talk about, the consumer staples. And for us, that one goes without saying because, again, it's a space where it's supplying essential goods into the economy. And demand has been very resilient across the consumer goods. If you look at the agric names or just the broad consumer names, it's again a space that we are encouraging investors to look at. If you have a few pennies, do invest in a lot of the consumer names in Nigeria because we do think this is a year where we'll see earnings momentum come through again. Your second question was about underappreciated spaces. And, I think a space that is underappreciated, maybe somewhat mispriced or somewhat misunderstood, is on the infrastructure investing and perhaps private credit side of things. It's a space that we are seeing a lot of interest from an investor perspective come into the market. So 2025, and I think going to 2026, we are seeing many more transactions looking at that space. Why? One, there is a large pool of projects that are looking for financing. And where you have well-structured transactions in the infrastructure space, in the private credit space, they're often structured with strong security packages, good cash waterfalls, strong reserve accounts that help ensure that from an investor perspective, your investment is well-structured, that you have cash flow visibility over time. And so a well-structured infrastructure deal, for example, provides not only yield enhancement, but it also provides a long-term annuity cash flow to the investor. And from, to your point about the economic multiplier where you can channel private, capital market money into private credit, into infrastructure is immense. And so it's a space that we think we're going to see a lot more investor activity within. And so we're also encouraging investors, as you look at your portfolios broadly and you invest in fixed income, you invest in traditional equities, these alternative markets, infrastructure, even real estate, are spaces that we shouldn't forget for 2026.
Thank you so much, Laura. And no wonder First Asset Management produces one of the highest returns in the industry. I can understand the brains behind those numbers. So thank you so much. Cheta, please get ready. Can we get one or two questions from the in-person audience? Anybody with any question to our panelists? Anybody? Any question from the audience? I've been taking so many from the online audience, so okay, it looks like we are doing great justice to some of the things that are already in your mind. Cheta, I will come to you right away. Can we spotlight Cheta? So Cheta, I have a question, an interesting question from an audience, and it looks like the person asking the question knows you very well. So he says, Cheta, your work focuses on intelligence and underlying societal pressures. Resilience often means weathering shocks. Looking at 2026, what is the most under-discussed but potent socio-political or security risk to business continuity and supply chains in Nigeria? And how can a CEO sitting right here with us or on the online platform practically build a buffer against it into the annual plan? So how will CEOs build the required buffer into annual plans to withstand the unforeseen or potential shocks in the economy? Cheda, can you hear me?
Yes, I can
Yes,
hear
I
you.
can
Can
hear you.
you
Can
hear
you
me?
hear me?
Yes, please. Go ahead, Chita.
Okay, thank you, and Happy New Year, everyone. This question has two parts. So let's start with the first one. What's the most under-discussed um, but potent social, political, or security risk to business continuity and supply chains in Nigeria? Um, it's so for most people will quickly say that, oh, that it's insurgency, it's attacks, but I don't think so. I think that those are symptoms. The real under-discussed issue is the effect, the breakdown of informal social contracts at the community level. So, and this basically has a cascading effect. It has three layers. So let me give each layer with a sort of a consequence and then maybe a small example. So when you have if you have the first thing is failure of basic security, which tragically has been happening quite a bit, especially in northern Nigeria. And the consequence for supply chains is you have cases where farmers abandon vast farmlands, rural transport routes become where you can't operate on them because of banditry and kidnapping. I mean, I don't think I need to give examples of this. It's been happening. It's been in the news. We've seen it, and very unfortunately, after the Christmas Day present from the Americans, there seems to be an uptick, especially so we've had two incidents in the past 48 hours, one in Borno and one in Niger. So that's one layer of the breakdown. And what this leads to is the one that I really want to focus on, which is that loss of social license. Because when people are no longer there, or when those who are there are desperate, they see no benefit to working with the state. Essentially, what they do is they begin to they facilitate some of the things that insurgents or terrorists do in order to keep safe. They fail to report attacks on logistics, and we see it. For example, our telcos have been reporting attacks on base stations. These attacks on base stations are not reported. So basically, people are logging out of society. So the increase in hijackings, theft on goods in transit, that is an effect an effect of the breakdown in the social contract. That is something that is very key for business. You need to have a society that is plugged in. um, you need to have a society that really believes that they have a stake in what you are doing. And the third layer of this breakdown is what we've seen in Nigeria, in Venezuela, which is external intervention, where foreign actors will say, oh, we have to take matters into our own hands. Whether their reasons are cogent or not is a moot point. The point is that they are taking matters into their own hands and they are beginning to intervene in your country. So, to the second part of the question, how can a CEO, how can a business um, basically help or build a buffer against this in their annual plan? Um, the first thing is investing. You need to invest in community intelligence. One of the things that community intelligence will help you to do is to understand local grievances. Now, when you understand those local grievances, it helps you build a scenario, plan a scenario as to what is likely to happen. It also helps people begin to give you information because they trust you, they get something from you, and it enables you to track potential problems and build against them before they happen. So community intelligence, investing in community intelligence is very, very important. Secondly, I would say decentralized logistics. Now, if a business has alternative routes or alternative areas of local storage, they can very easily pivot when a major highway is compromised by reports of kidnapping, community unrest, a blockade here or there. It makes it very easy for them to pivot. You can also empower regional managers with budget authority, with a budget and the authority to reroute some of these shipments based on this local intelligence. So you see where it works, where these things work hand in hand. You have invested in community intelligence, and because you have invested in community intelligence, you know you have a fair idea of what is happening, and because you have decentralized authority, decentralized decision making, your people can be nimble on the ground and act very, very quickly. So this is actually a very classic example of what both Dr. Kale and Mr. Francis mentioned: adaptive strategy. You've adapted to the situation on the ground. And then another thing that is local stress testing. So if you have what I'll call social license stress tests, you scenario plan for sudden loss of access to a critical trade, to a critical trade, a critical region, a critical area, and then because you have planned this scenario planning, you've done your stress test, you already know. So a practical example. Um, you need to supply goods from Okene in Edo State, Okene in Kogi State to from Okwila in Edo State via Okene to Abuja. But suddenly something happens around the Okene axis. How do you go around? Oh, you know that there's an alternative route. You go back south instead of going north from Okwila to Okene. You go south from Okwila to Agenebode, cross the river Niger, attacking Ebode to Ida in the same Kogi state that Okene is in, and then use the alternative route to move your things to Abuja. That's scenario planning, alternative scenario planning. So these things are the kind of things that a CEO who is invested, who wants to build a buffer against some of the things that we are seeing, can put in their plan.
Very interesting, very insightful response from Cheta. Cheta, thank you so much. Please, can we have more questions from the audience online? If there's anyone, I'm still available to take them. As we try to round off this session, I would like one or two of our panelists to just give our audience, both in person and online, some specific actionable insight and takeaway from here. Again, in a simple terms, Nia, I will come to you. If you're to complete a sentence for an executive who is here or online, who is regardless of the sector the executive operating, who says, what is that one strategic initiative that they should start considering in Q1 or start funding in Q1 to build resilience and growth into their business DNA? What would that be? Just in 1 minute.
You're asking a consultant to give one word. That's difficult. But I think I would say it's really around operational excellence, right? How can you review your processes, your procedures, your operations, your different scenarios to allow you to operate at peak performance, but more importantly, to allow you to deliver your promises. Whether the promises are to your staff or to your clients, your partners, or the government. So I would say that would be this operational excellence that will allow you to operate at such a level that you can walk your talk and deliver your promises.
Thank you so much. Also, I will turn to you as a banker par excellence, a banker that works with an institution that's been over 131 years old. What is that one specific strategic initiative that you'll be telling a CEO to build into his business DNA to achieve resilience as well as growth?
Well, it will be building resilience. If you have a resilient engine, what will be in it? From where I see it, two critical things today. It would be energy independence and cash flow agility. And why? Why these two critical? The market is there, the opportunities are there. The question is, how do you get the market to turn to revenues? So if you have the energy question sorted out, and your cash flow agility in the right shape, we believe that you begin to run an operation that is not just credible, but set for growth. Now, captive or hybrid energy will give you the capacity, particularly when you have the right kind of cash flows, the right sort of structures to support ongoing revenue generation. You should be able to mitigate some of the shocks that will typically come up in the course of the year. It will help you to maintain uptime, cash viability, and planning without noise. Many of the planning we see are on Faces of Arise News TV and channels and all that. But the real noise we want to hear is that your goods or service is available at the right price, at the right place, and like Francis said, producing at scale. This whole idea of act far, we're already seeing it happen. People are producing, most of the cement companies in Nigeria are the ones producing for the whole of West Africa. They are supplying all the way to Burkina Faso, Mauritania, Mali, from Nigeria. It's already happening. It's just that sometimes we like the noise, but the facts often supersedes the noise. So we believe that if you get this ready, you're already engineering the resilience of your future. At First Bank, we have experts that can guide you in the journey of building a resilient engine. So what is our request this morning? Come see us. We are waiting.
Thank you so much, Osaho. Laura, I will come to you. I know the firm you work for, First Asset Management, again, guides and provides advisory to clients who are looking to grow wealth, who are looking to expand their financial capacity by earnings from various instruments and various banks. So what is that one specific strategic initiative you'll be telling a CEO who wants to build resilience and growth into his business DNA?
Okay, so, one of the things that Dr. Yemi spoke about was resilience and adaptability. And whilst mine, I think the very first thought I have is not particularly investment focused, but it's about automation. So one of the things that I think is very important is to embrace automation for all of us, to embrace automation in our lives. And that's even when we think about how we invest, even when we think about where we invest. And it really is for all of us, so as businesses, as individuals, to prioritize wealth creation, to prioritize creating a personal investment plan, to prioritize creating a diversified portfolio. You can do it yourself, you can do it with AI, you can work with managers, you can work with, I think within the group as well, we have, a stockbroker, we have all sorts within the group. So ultimately, the point is to prioritize personal wealth creation, because the truth of the matter is we hope and we pray that we all live long enough to retire. There is a long time, there's a lot of life expectancy that happens after you stop working. You want to be able to stop working at 55, at 60, and live for another 20 years in good health and in good wealth. And that takes deliberate planning. And whilst there is a pension plan, etc., from a regulatory perspective, the truth of the matter is individually and collectively, we all have to prioritize creating wealth, creating investment plans, and ensuring that we have an income, a steady income that can sustain us for, let's say, another 10, 15, 20 years, hopefully in health, in wealth, and in happiness. So that, for me, is what I would say everyone needs to focus on. It's never too early to start. Most people sort of think, oh, I have a long time to retirement, I can start in 10 years, but actually, the earlier you start, the better. So it really is about being very deliberate.
Thank you so much, Laura. And as we draw closer to the panel session, I would like to thank my panelists. It's been a wonderful time interacting with you and you giving insight to our customers. And to our customers, I would like to assure you that as we've assembled these experts, all of them are partners and strategic partners of First Bank. So even the insight they've shared, if you want to reach them, you can still reach them through First Bank. And we continue to build those collaboration and partnership that will enable us to serve our customers better and take you to that journey where you want to achieve the best of your best and the best of your company. So I thank you for listening to us. The conversation continues. We have several offerings at the First Bank Group level, at the First Holdco level, because First Holdco is a diversified financial services institution with several business verticals. Laura did mention there's a brokerage, business within First Holdco. There's a trustee business within First Holdco. There's a diversified commercial banking, the iconic institution called First Bank, where we give you and serve you to help you grow your business. Thank you so much. And thank you to my panelists. We appreciate it. So we'll take the closing remarks, formal closing remark from the DMD before we take the group pictures. Just 2 minutes closing remark from the DMD of First Bank Group. Thank you.
Good morning, everyone. First of all, I would like to thank you all for attending 2026 Nigeria Economic Outlook. I must start by thanking our keynote speaker, Dr. Yemi Kale, and all our distinguished panelists who certainly did justice to the topics. At First Bank, we're very pleased to, serve you, our customers, and we really appreciate the fact that you take time out at the start of the year to rub minds with us on this theme. As mentioned, the theme we chose this year, the Great Recalibration, Mastering Resilience in an Era of Asynchronous Growth, is very important. And we really do appreciate that you found time to join us today. It's quite apt. It's the start of a new year, and as the distinguished speakers have clearly showed us, certainly a whole range of opportunities and changes that we should all be prepared for in 2026. So my task is very simple, just to say a big thank you for being here, big thank you for your business, and to be rest assured that First Bank stands ready to work with you in partnership, not just in 2026, but also beyond. Thank you very much.
Thank you, DMD. So we've formally come to the end of the program. We'll take group pictures. The media team.